Okay, Hélène, hello. Can you hear me?
Yes, that's fine. I'm
Okay.
trying. I will try to put the earplugs, and I will try it with the earplugs.
Okay.
Yeah. Okay. Can you hear me too?
Yes, I can hear you fine.
Okay, cool.
Can you see the screen that is being shared right now?
Yes.
Yeah.
Yeah. What's working?
Okay.
Yeah.
All right. So I'm going to share the presentation, and we'll start pretty soon.
Yeah.
So welcome back to this session of the annual conference of the Research Center at Audencia, Audencia's Research Center on Multi-Capital Accounting. And we are going to start this session that is dedicated to the presentation of the multi-capital accounting model that we have developed at the Research Center. We have named it LIFT for Limits and Foundations Towards Sustainability Accounting Model. And during the next hour and a half, we will be presenting the methodology and an illustration, as well as interacting with our panelists and taking questions from the audience. Let me remind you of the housekeeping rules. So when conference speakers are speaking, their video and their microphones are on. When I will be not speaking, I will switch off my video and my microphone. And please, we ask that all conference participants switch off their videos and their microphones at all times. If you have any questions and comments, use the chat, and we'll pick up the questions on the chat as they come to address them during the moments of the presentations that will be dedicated to that. Also, be aware that the sessions are recorded because they will be available on a replay mode on the web pages of the Research Center. First, let me introduce the participants, the speakers, and the panelists. And we will start with Hélène Le Thénault. Hélène Le Thénault. Hélène, would you like to say a few words about yourself?
Yeah, thanks, Nicolas. Well, right now I'm the director of Jean-Noël Torel Foundation. That's quite a specific organization because it's the shareholder foundation of a company named Naos, which is a skincare company with cosmetics brands like Bioderma. So my first role is to be directing this foundation, which is owning a company. And that's one of the reasons where I will be talking during this roundtable now, is because I can testimony what type of changes we have been making in accounting within this company. And the other reason is because I'm part of the scientific committee of the Global Performance Accounting Research team in Audencia, and I'm very glad as well to provide some insights and testimony of pilot studies that I've been witnessing recently.
Thank you very much. Coming next is Emmanuelle Cordano, a member of the Research Center, who will be doing the presentation with me. Emmanuelle, would you like to say a few words about yourself?
Yes, thank you very much. Thank you, Nicolas. Thank you, Hélène. I'm glad to be part of this session today. So my name is Emmanuelle Cordano. I'm an accountant by education. I'm a US CPA and French chartered accountant. And I have done most of my career in finance, specifically in financial reporting and IFRS as an expert of those issues. And 4 years ago, I moved from finance to CSR, where I was responsible in a large French company of extra financial reporting. Last year, I decided to create my own company, CSR for Finance, in order to help and specifically finance departments, finance people on the extra financial reporting challenges. I had the chance to meet with Delphine, who proposed to me to join the research center. So since last year, I've been contributing to the research center, specifically on the accounting part, on the accounting model part that I will be presenting with Nicolas right now. And Nicolas, maybe if you want to present yourself.
Okay. Is my screen still visible?
Yes.
Okay, very good. So very quickly, I'm Nicolas Antheaume. I'm Associate Professor at Audencia's Research Center on multi-capital global performance. I have had a very early interest in accounting for the environment. I was, for example, one of the very first project managers who was recruited a long time ago by the French Order of Chartered Accountants to create a task group on environmental accounting. That was more than 20 years ago. I'm also a professor at Université de Nantes in France. So that's a quick word about myself. And now we are going to move on to the agenda of this presentation. There will be 3 items. The first item will be a presentation of the accounting model that was developed by the Research Center, the LIFT accounting model. LIFT stands for Limits and Foundations Towards Sustainability. We will be doing a general presentation of the model and its main principles. After this first item on the agenda, there will be time for conversation and questions with our panelists, Hélène Le Ténot, and we will also take questions from the audience. And then we will move on to the second item on the agenda, which is an application of the model. Using the example of climate change, we will try to show you how we follow 3 steps in applying the model to one dimension of one of the capitals, which is the natural capital, using climate change as an example. And after this second item, we will have a conversation and reactions from our panelist, Hélène Le Ténot, and we will also pick up questions from the audience. If you have questions, please write them on the chat, and after each item, Delphine Gibassier will come in and deal with the questions that she has seen on the chat. And then we have a brief third item where we will talk about the next steps. Where do we want to take this model to, and what is still ahead of us? And once we have done a quick presentation, a few minutes of the next step, once again, there will be time for questions with our panelists and questions from the audience. So that's it for the agenda. And without any further ado, let's start with a presentation of the LIFT accounting model. Remember that LIFT stands for Limits and Foundations Towards Sustainability. Our model, developed by the team, stands at the crossroads of 3 major concepts. The first one is that accounting has been around for a long time, hundreds of years, if not more, and it has developed into a language, a set of techniques and technologies that is universally understood. So we make the choice of using the language of financial accounting as a basis to develop our model and adapt it. And we use that for the purpose of informing businesses, organizations on where they stand and where they are in terms of how they contribute to the respect of planetary boundaries and social foundations. And we will come back to that. But the idea is that the economy and thus organizations will be viable only if they contribute to the respect of a certain number of environmental limits, planetary boundaries, and if they contribute to building the social foundations which give an opportunity to humans to live a life that is worth it. And this can be understood if we look at corporations, not just as legal entities from a legal point of view, but if we look at the idea of extended corporate responsibilities. Corporations and organizations develop business models. They make choices in terms of suppliers. They make choices in terms of the products and the services they provide. And thus, we are looking at corporations from the point of view of the influence and the impact that their supply chain has, the impact of their operations, and the impact of how the products and services are distributed, used, and dealt with at the end of their life. And we include how this impacts society as a whole. So at the crossroad of these three major concepts, there is our model based on a certain number of principles. The first one is that if you are to inform organizations on where they stand as regards the respect of planetary boundaries, environmental limits, and their contribution to social foundations, this can only be done adequately to start with if you are using physical metrics, not financial ones. So the basis of our accounting model is accounting for physical flows, which are needed to measure the progress towards the respect of planetary boundaries and the contribution to social foundations. And since we have different dimensions of environmental limits and different dimensions of social foundations, we have different physical units, and they cannot be compensated with one another. This means that poor performance in one dimension cannot be compensated with good performance in another dimension. The idea is that we go beyond reporting on what companies do. Our ambition is to build a model that will inform managers in organization so that they can drive an internal transformation of the organization towards sustainability. And that implies that we have verifiable data, that for each element of data that is recorded, please switch off your videos because they keep popping up on my screen. Please, thank you very much. That the data we use for the recording of accounting flows is verifiable, that there is an audit trail and an amount of transparency that we can guarantee. And of course, although we have very diverse profiles at the research center, we are humble accountants, and we build on the shoulders of giants, of people who have already contributed to the knowledge that exists on planetary boundaries and social foundations, and we build on that scientific knowledge to inform our accounting model and to provide guidance on the targets to be met and the objectives. So these 5 principles have a number of implications, and we're going to look at these implications. The first implication is that we introduce a different perspective on the economy, and this was already addressed in one of the previous sessions. We are not considering that the organization is separate from the natural environment and society, and that it is part of it. So we include the organization in the system, and we address the 3 capitals: natural, social, and economic. But if planetary boundaries and social foundations are to be respected, it is imperative to rethink the idea of economic performance. Businesses, and therefore the economy, will only be viable if they contribute to building a viable society, and society itself would only be viable if the ability of the planet to preserve life and the resilience of existing systems will also be preserved. So the economy is nested within society. Society is nested within the environment. And so this brings me to introduce the concept of planetary boundaries and social foundations, which is based on work by the Stockholm Resilience Center on dividing and interpreting, describing the limits of the planet in terms of 9 different planetary boundaries, and by the work of British economist Kate Raworth, who added to the idea of planetary boundaries the idea of social foundations. So if you look at it from a global scale, an economy will be viable if it is within the donut that is illustrated here in this picture. The economy will be viable if it builds the minimal social foundations that are needed for people to lead a happy life as much as possible. And an economy will only be viable if it doesn't go beyond the ability of the planet to sustain life, and therefore the economic activity must not overshoot these limits. Above the inner circle, inside of the outer circle, is a just and safe space for the economy. So if you've taken that from a global scale, and there's already plenty of challenges that are still being addressed, our work is to bring that from that global scale to an extended corporate scale, and to translate what these limits and these foundations can be at company level, measured by physical indicators. Of course, here science will help, but we also have to do a bit of prospective thinking and put ourselves in the shoes of what would happen if there was an allocation process that was politically driven. We're not there yet, but we have to have in mind that this has to happen, and we have to break down the planetary budget into a budget for the company. What is a fair share for each planetary boundary and each social foundation for the company? And the result is a budget that is allocated for each limit and each foundation. So how does an organization contribute to the donut economy? Its objective is to remain in the donut. And this drawing helps illustrate that we need to change the way we do things and the way we think. If, as Robin Hood, you pride on being on target, well, you won't be in the donut. You'll be inside the circle, but below the social foundations. If you miss the target, you'll be out of the donut. The idea, as illustrated by this drawing, is you have to be on the donut. Another implication of our principles is that if we look at the idea of an extended corporation, we have to divide our object, the extended corporation, into a number of perimeters. There is the perimeter of operations, which are under the control of the organization. There is the perimeter of the supply chain, and the perimeter of the products and services that are distributed, used, and dealt with at the end of their life. And these 3 perimeters make up what we usually call the business model of the organization. What does it propose in terms of value? How does it propose it, and to whom? And so we consider these 3 parameters as being the business model, and we consider the impact on society as well. Let's look very quickly at an example with natural capital, the case of climate change, and social capital, the case of income and work. If we look at operations for climate change, we will consider greenhouse gas emissions that are linked to the company's activities, direct emissions, energy consumption, travel, and so on and so forth. When we look at the supply chain, we will look at greenhouse gas emissions that are linked to suppliers and service providers. We would look at those emissions that are linked to purchases, inputs to the company, and the transport that these inputs imply. When we look at the perimeter of products and services, we will look at greenhouse gas emissions that are related to the use of the product or the service during its life and what happens when the product is terminated or the service is done. And all these three parameters make up the business model, which we also want to analyze in terms of how it is designed. And of course, the idea is that this business model, made up of these parameters, must not force society to break its climate commitments. Now let's look at the parameters with social capital, the example of income and work. If we look at operations, we will check if the remuneration of the company employees is higher than the living wage. That implies having a standard for defining the living wage. If we look at the supply chain parameter, we will check if the remuneration of employees of the company's suppliers and service providers is higher than the living wage. And when we look at product and services, we will check if the products and the services are proposed at a cost that allows them to be purchased by anyone who needs them. And if we consider the impact on society, the idea is that even if the company is careful as to the respect of the living wage and the affordability of its products and services, it is not exempt from contributions to public funding, which help advance the agenda of giving everybody a living wage. So that's for an example of the division in two parameters and two examples. Now, we have a division in two parameters that is compatible with existing parameters and that can be reconciled with them. For example, if we take the scopes of the GHG protocol, here's how our parameter can be reconciled with scopes 1, 2, and 3. When we look at operations in our parameter, it concerns scope 1, combustion, and scope 2, the emissions from the sources of energy used by the company, and part of the scope 3, items that are linked to transport and fixed assets that are used for the company's operation. And then, if you look at our supply chain parameter, we have the upstream of scope 3 for the suppliers and the downstream of scope 3, which is also part of our supply chain. And if you look at products and services, how products are used and dealt with at the end of their life, this is also part of scope 3, usage and end of life. However, we have one extra dimension, extra parameter, which is society. I will not go into details as regards life cycle analysis, but what this diagram shows is when you look at how life cycle analysis is also cut into different segments of the life cycle, it is possible to reconcile the different steps of the life cycle analysis with our different parameters. So how do we now take our model and integrate it to accounting? We do it through non-financial entries. The first step is that for each limit and each foundation, we will calculate a budget. And that budget will be assigned to an inventory asset if the limit is something that is not to be exceeded. We could take the example of a CO2 equivalent, a carbon budget that the company must respect. Other ways, we will assign the budget to a debt and treat it as a liability if it corresponds to a foundation to be respected. For example, if a foundation to be respected is living wage, we will consider that the company has a duty, a debt, an obligation to make sure that all the employees within the perimeter are paid a living wage and that its products and services are affordable when you compare them to the living wage. And this will be done with non-financial accounting entries on each of the parameters for each of the limits and each of the foundations. And then we will monitor the actual consumption of these budgets through physical accounting entries. Whenever a company purchases goods, there is an environmental and social incidence to the purchase of these goods across many limits and foundations. So we will try to translate that purchase of goods into a consumption of budgets for limits and budgets for foundations. So if it is a budget for a limit, there will be a decrease in the inventory if the limit is not to be exceeded. And if the company is going towards the contribution to a social foundation, we will record a debt reduction if a foundation is being respected. Then, as soon as the limit is exceeded, or if the foundation is not met, we consider that the company has a net debt. It has failed in physical quantities to fulfill an obligation or to respect a limit. And this is translated in the end into non-financial statements for each limit and each foundation. And it is going to be measured with physical indicators, with its own balance sheet and its own statement of profits and losses. And at a later stage, or at the next stage, of course, these physical units can be translated into money or something else if we try to consider a visual restitution of where the company stands across all limits and all foundations. At the beginning, I said that we have chosen to use the universal language of accounting, and financial accounting entries are also an entry point to our model. There are plenty of financial accounting entries which have a traceable environmental or social incidence. They can be categorized and they can be matched with generic or specific environmental or social metrics. I said, for example, if you purchase goods, there is a description of the goods that are being purchased on the bill, and you need to find the data that specifies the quantity of each type of material that is in the goods. You need to find data that specifies the number of kilometers transported. You need to check that your suppliers are paying their employees a living wage, and so on and so forth. But you take that bill, which records a purchase of goods, as the starting point to trace physical data that translate that purchase of goods into environmental or social consequences. Of course, there are also accounting entries which have no traceable environmental or social incidents. So we put them in the different categories, but we keep them on record for audit purposes. And although financial accounting entries are a useful starting point, we also consider that there are supplemental non-financial entries to be made because there are events, such, for example, as the commuting of employers between from their home to their workplace and the other way around. We consider that these events have an environmental or a social incidence and they're not recorded in financial entries. So we add supplemental entries to make our model as comprehensive as possible. And because we use accounting entries as a starting point, and because we rely also on documents which enable us to make non-financial entries, we try to produce a trail of documentary evidence and evidence that data exists, which helps us facilitate audit and transparency. We can match accounting entries at all time. We keep them on record, so therefore we can take all our non-financial entries that are in the model and trace them back to the financial entries and check that we can reconstitute the financial statement of profit and losses and the balance sheet. This makes sure that we haven't omitted anything, because when we add the financial entries that have a physical consequence and the financial entries that have no physical consequence, we should be able to recalculate the profit and to represent a balance sheet and a financial statement. And we also make sure that we put a non-financial control into place. Data that is physical data also has to be traced back to documents that were initially used to generate the physical entries. We have one model, but of course we are considering several restitution units. The restitution of this model can be done, of course, in physical units that are specific to each limit and to each foundation, but we can think of the idea of translating it into other units. Monetary, because this seems to be a request, but we could also consider a non-monetary unit that would give an overall vision of where the company stands. And here is a quick example of how we could visualize where the company stands. This is an illustration of an organization with which we have worked on one planetary boundary and two social foundations. So here, what you can see is with this organization, if you look at planetary boundaries, and if you look at climate change, which is one aspect we investigated, this company is out of the donut. It has used more than its budget. If you look at the social foundations we investigated, education and income and work, what this visualization shows is that the organization we investigated does not contribute enough to the education social foundation, but if you consider income and work, the living wage, it is in the donut. As we progress on the model, as we try to better use existing scientific knowledge, an ambition would be to provide a visualization across more planetary boundaries and more social foundations. There is a lot of work to be done. But what have we done so far? So far, we have worked with 3 SMEs. The cases will be presented just after this session. 2 service companies, including a group and a production company. They made their data available to us in order to experiment and create a first version of the model using Access as an accessible software to model the information system dimension of our model. We have, as a team, then developed and written the methodology throughout the experimentations with the SMEs, and we presented the results to these SMEs in March 2021, and coming up next, we'll share some of these results with you. The next step is that we will apply this model to the case of the founding partners of the research center, namely L'Oréal and Danone, and we will continue our work on the remaining elements to be developed in order to improve the testing of the methodology. Now we have reached the end of our first item on the agenda, and it's time to take a few questions. But first I will start with Hélène Letenot, our panelist. Hélène, could you tell me, for the Jean-Noël Tourelle Foundation and for the company that supports it, what does this accounting model represent for the foundation and for the company that supports it? What's your interest in it?
I would say that I have been interested into these types of accounting innovations for years. So when I joined Jean-Noël Tourelle Foundation 2 years ago, I I brought with myself the ideas of Delphine and of the team is how could we account for what really counts? In other words, additionally, and at the top of financial reports that are provided by the CFO and of conventional budgets, can we really pave the way for a sustainable pathway for the company? And when I arrived, I discovered, like it's very often the case, that the board of the company and the CEO did not have the figures and the data that would help them to make the right strategic decisions to make the business sustainable, whether it is on environmental matters or social foundations. So the first use that we have made of these tools is let's speak about it. Let's have an open discussion about new accounting frameworks. What's the science about these planetary boundaries? Why would we need new tools to measure new items? And I have to say that so far we have made a few steps. Step number one is to train the CFO and its team about these new tools. And step number two is make sure that the board will be happy to read some of these reports and will use it. Because there is nothing worse than a tool that is not used afterwards. So because I'm sitting on the side of the shareholder foundation, my role is not to get myself very knowledgeable about all the details of the tools, but make it work. But also my role is to make sure that the board sees value into those tools. So what I can say is that it's not so easy because even when we are in a company that has a long-term focus because of its governance, we are a non-listed company. So we can think the midterm and the long-term issue more easily probably than some listed companies. Having said so, there is a real change in mindset that's needed is what is really creating value for the long term. And why is it so important to take care of the three capitals, financial capital, natural capital, and social capital? What I would say is that I'm very positive about what we have achieved so far is let's speak about it and let's train people. And I'm quite confident that it will happen soon. But what I wanted to share is that most companies that I have met, the board members are not very aware and not very willing to make use of these tools. So there is a huge effort to make, not only on financial profession, but also at the board levels. And I would say on the what we call administrator, which is members of all the committees that are owning the companies and giving the routes and the pathway to these companies. But that's where we stand right now. Is that's very precious, and I think that's a must. That's a must for the years to come, and companies really need it. That's what I want to say. So I'm happy to share this. We think we really need it, but it's not easy to start, and we will keep on trying.
Okay, thank you very much, and we'll continue this discussion. But maybe we can see if in the audience, Delphine, there are some questions on the chat.
There are some questions in the chat. I'll start with a questions from Thomas Nouvian about how do we measure planetary limits in foundation? Do we use one or many indicators? So that's maybe for you, Nicolas, to answer.
Mm-hmm. Yes, we use many indicators. We really do not try to guess ourselves which are the right indicators to use. As much as possible, we rely on existing scientific work from people from other disciplines. For example, when it comes down to planetary boundaries, we rely on the work of the Stockholm Resilience Center. For 9 of the boundaries that they have defined as key to the planet's ability to support life on Earth, there are 2 for which they have not been able to identify with certainty what would be the right indicator. An example is the introduction of man-made chemicals or elements into the natural environment. And there are others for which they have been able to measure and to provide indicators. For example, if you take climate change, they have managed to calculate what is the global carbon budget that humanity has to spend if it wants to stay within the Paris Agreement trajectory. If it comes down to fresh water withdrawals, it has concluded that this is a local indicator and that there are many indicators to be developed. But they have, for example, concluded that for freshwater withdrawals, we should not withdraw more than a certain percentage of the locally available resource. And that enables to provide a global outlook on how freshwater is used in different places on the globe. So for each planetary boundaries, there has been a work on developing a scientific consensus on how to measure it. And this is what we plan to use and rely on. As for social foundations, we are trying to use the work of the United Nations on the Sustainable Development Goals. Kate Raworth herself has proposed 12 social foundations, such as access to food, access to energy, justice, living wage, education, and based on the work of existing international organizations, she has provided indicators. The challenge here will be to translate these global indicators into something that the corporation is obliged to do to contribute to the construction of a social foundation. So here are a few elements as an answer to this question.
We have a question for Helen. If you'd like, it's a question on how do you expect businesses with more diverse boards will be more accepting of the multi-capital accounting? Was this consideration part of the piloting that will be for us, and were the organization self-selecting? But maybe on your side.
On the first part of the question, I'm quite sure that companies with more open governance, and I will specify what, are the most likely to experiment these tools in the first place. When I say open governance, I talk about what Germans call steward ownership companies. You could refer, if you like, to Purpose Foundation work, and they have written a booklet of case studies about steward ownership. It's companies who have a focus for the long term, who care about planetary boundaries and social foundations, and who have a composition of the board and also of the capital, the shares of the capital and sharing of voting rights that are quite different from normal companies, including shareholder foundations, including shares owned by staff, and including in long-term investors, meaning that all these stakeholders are willing to have these figures and these tools. So in France, we have some of it under the perimeter of purpose companies, which have been flourishing somewhat. But purpose companies only have a purpose committee that is not the board itself, and as such, it is still quite weak. So a lot of purpose companies will use these tools, but it will not be made for strategic decisions. So my point is, if you want to have it, the best use of it, that's best if it's fitted with what the owners of the company are looking for.
Thank you very much. And just to answer the questions, the second part of the question, at the moment, the companies who are testing with us are indeed kind of self-selecting them to work with us. We are at the moment going into the second part of the work with larger experimentations, but also we are talking with SMEs and chartered accountants in France to continue piloting with extensive more organizations, but at the moment, yes, it's on a voluntary basis that people are self-selecting to pilot with us. And maybe a question for Nicolas about, I'm just going up, I was trying, yes. Is it true that this model allows to be used to set performance norms and measure actual performance?
That's the ambition. Obviously, one difficulty, one challenge that we'll have to address is that since we have objectives for each planetary boundary, objectives for each social foundations, and then objectives for economic performance that are to be met only if planetary boundaries and social foundations are respected, the ambition is to be able to set these objectives. The difficulty is that today there are limits to existing scientific knowledge on even what are these boundaries at a global scale, and there are even more challenges to be addressed as we try to challenge and to translate global indicators on climate change into budgets to be respected by each corporation. So we will go through that process where knowledge or scientific knowledge is missing. We will say it is missing. We will make proposals, but these will have to be modified as knowledge on these issues improve. But yes, the idea is that there are different sets of performance indicators to be met, budgets to be respected for social foundations, for planetary limits, and also economic performance targets to be met. I hope that answers the question.
Yes, of course. I think there is a comment about training for the board of directors. Maybe, Hélène, you just want to say a few words about the...
Yeah, what we're trying to start with our university, there is a link between figures and frameworks and values. So about value and values. So here we are talking about very serious stuff about how we can account for what really counts. But what we try also to promote and to push and to educate is how senior executives can be better aligned between what they feel and what they do as an executive in companies. So we, as the foundation, are launching and funding Heart Leadership University. And we have a first pilot program called Straight from the Heart, where one of the topics covered will be this type of accounting framework. Because we really think that if there is only values or willingness to go and no tools, we do not get the results expected. And there are only tools, but no values or no ethics, then there is no result either. So what we are trying to promote right now is that if some companies and if some executives want to go in that direction, they get the proper tools. And it needs a major change in executive education. As we see it, these topics are not well covered in most of executive MBAs or MBAs for CFOs. And there is a real opportunity to go and train a lot more people about these topics, whether or not they will use it or not later, at least that they discover that this can be done. And if, again, it fits with their personal values and with the culture of the specific company, they will be able to know how to use it.
I can only agree with that. Delphine, any more questions? So we move on to the second item on the agenda, and then we'll have time for more questions after that second item.
Maybe one remark. Somebody was asking to show the P&L that we have been doing. This is coming.
It's coming.
And then one more remark on whether indicators have the same consideration for all type of enterprises. I just wanted to remind that the work that we do is based on sustainability for everyone as a community, for us. So therefore, the societal and environmental indicators are not tailored to each organization. They are tailored to measure sustainability. And then we look, of course, at how each business model has a link with the sustainability potential risk they are bringing, but we do not tailor indicators per organization, because what we try to measure is whether the organizations are contributing to unsustainability or to, on the other side, bringing us back to a sustainable world. And then I'll pass it on back to you, Nicolas, for the rest of the presentation.
Okay, so now we move on to the second item on our agenda, which is how we apply the model to natural capital. And we will take one dimension of natural capital, which is climate change, one of the 9 planetary boundaries in the model of Kate Raworth, and using one indicator, which is greenhouse gas emissions. It's important as a preliminary remark to understand that for the case that we present here, we are not communicating confidential information. We have fictional data on the following slides, but that data is important to present the physical accounting mechanisms that are at the center of the tool. Our model is implemented in 3 steps. The first step is an analysis of the business model. So our objective here during this first step is to get to know the entity and its activity and its process, and to understand the objectives of the organization, their interest in the method, and to analyze the business model so that we can choose what dimensions of sustainability should be addressed as a priority. Then there is a second step, and I will hand over the presentation to Emmanuelle Cordano for that second step, is how do we define the parameter that is analyzed, the period that is covered, and the budgets that we want to follow. And then we will try to obtain accounting data and non-financial data, process the documents, and integrate the data to Access, which was for the moment the software solution that we developed, but Access is nowhere an end in itself, but a means by which we integrated information system considerations into our model. And then we have to perform the calculations and obtain some of the data. Then comes the third step, is the visualization of the results. So there's going to be a P&L and a balance sheet coming up soon as a presentation of that third step. So let's start with the business model analysis, getting to know the company. Obviously, our ambition is that we have a model that is suited to sustainability objectives, which means that the indicators that we develop should concern all organizations. For one thing, there is not enough scientific knowledge to address all the multiple dimensions of the donut model. Organizations have priority, and we have to start with something. So the first step is getting to know the company, to interview management, and to interview people in the different departments, the HR department, management control department, industrial department, logistics, and to analyze the business model in connection with the Canvas business model. So we try to understand what is the value proposition, what are the key resources and the key partners that are needed to make this value proposition, and through what channels and what segments of customers is this value proposition offered. And of course, we consider a number of costs and benefits of this value proposition. And through this analysis of documents and the interviews and the understanding of the business model, we try to understand which limits and foundations are to be analyzed as a priority and what indicators will be needed to carry out our multiple accounting model. So once we have done that, we move on to putting into place a non-financial accounting system, and I will hand over that part of the presentation to Emmanuelle Cordano. Let me see if I can stop my presentation and let Emmanuelle take over.
Nicolas, I think I'm presenting now.
You're presenting. Okay, perfect. That was seamless then.
So thank you very much, Nicolas, for leaving me the floor. So we saw in the analysis of the company, we have seen that the first step is a business model analysis. And now we are going to talk about the technicalities of the non-financial accounting. So this step is itself divided into 3 stages or 3 steps: the preparation, the processing of the data, and then calculations. The first step, in that first step, we'll define the perimeters. We also have to determine the budget to be used in the calculation. We also have to get to know the chart of accounts that is used by the company we are analyzing, and control and perform a consistency check on the financial document we receive. So if I go into a little bit more detail, in terms of perimeters, we are going to look at the legal perimeter or financial perimeter. So what company are we going to analyze? Is it a standalone company or a group of company? So this will be the operation perimeter. Then we have the temporal perimeter. What year are we going to analyze? So we would like our model to be simultaneous with accounting, but to start with, our first experimentation on the SMEs, we have been using year-end financial statements from previous years. Now the scope of responsibility, this is a very important part of our model. So we have the operation perimeter, which is the legal perimeters, plus activities or sites that are under operational control. Operational control here is the same definition as the one you can find in the GHG protocol. Then the supply chain scope will include the scope of the suppliers. So our job here will be to look at the suppliers, the main suppliers of the company we are analyzing, and take and analyze and find the data or ask for the data for the most important suppliers of the company we are analyzing. Then we have the product and service scope. And finally, the society perimeter, on which we will also have to perform calculations. The next step is the definition of the budget. So when we talk about climate, we are going to use science-based targets, and more specifically, the absolute contraction approach, which is recommended by science-based targets. So for instance, in our example, if the emissions of year 2019 was 4,000 or 5,000 tons of CO2 equivalent, for the year 2020, the objective or the budget that we give to the company will be 4,790 tons of equivalent CO2 that the company can emit. So that's the way we have been working using SBT. One of the questions we have had in our model is whether we should use the objective of emissions for 2035 according to the same contraction approach model from science-based target, and whether we should give as a budget for the company not 4,790 tons, but rather 1,640 tons. So should we directly give to the company the objective of 2035? And after discussion with SMEs that we have been working with, we think that it was better to go step by step and to start with allocating the budget for 2020. So this first part being done, which is a very important part, then we look at the financial accounts of the company. And here are very important features that we need in terms of accounting documents. In terms of, we will ask the company the P&L and balance sheet of a set period. And it's important for us that the P&L be presented by nature of expense, meaning we would like to have the different accounts of, for instance, energy, travel, personal costs, as opposed to a P&L that would be presented by function. For instance, cost of goods sold, research and development, sales, marketing. So this we know is going to be a challenge for the large company we are going to experiment our model on from now on. But for the SMEs that we have studied, we had the P&L presented by nature, so we were able to work on our first experimentation with no problem in terms of presentation of the P&L. Then we also need some of the balance sheet accounts, in particular for the climate-related accounts. We need the tangible assets accounts, so property, plant and equipment in IFRS, because we need both the balances and the flows of those balance sheet accounts. For other capital, it's probably other type of balance sheet accounts that we will need. And then what we do is we will perform a consistency check. We will make sure that all the accounts that we get from the company, for those accounts, the net result is the same as the net result that was published by that company or that was finalized in their financial statements. So we start by making sure that we have the right accounting information. When we have been doing that preparation step, we can start by the processing of the information. So we have several steps in this second stage. We will categorize the entries by nature, so salaries, training, costs, sales, purchases of goods and services, costs of travels, for instance. And then we will add accounts that we call in French supplétifs accounts or supplemental accounts. They are accounts that do not exist in the financial chart of account, but that we need to create because we will, it will allow us to account for transactions that are not included in financial accounts. So for instance, we'll need to account for the emissions of CO2 for travels to and from the home for workers who go to work to industrial sites or to the headquarters of their company. So typically those type of travels are not necessarily directly accounted for in the financial accounts, but we will create supplemental accounts to make sure that we are able to account for those emissions of CO2. So what I propose now is to go through a presentation like this one, which is a presentation that we have developed for our IT system, because for the SMEs on which we have worked, we did not do all the calculation without a system. Actually, we used the access system. And this is the flow, the data flow in Access that is going to be presented. So here we find the steps that we already talked about. The first step is a business model analysis. Then we have the preparation of the information that we already talked about. So on the right-hand side, you can see the donut and the accounting entries of the budget, because we have performed already the calculation of the budget that is allocated to the company. So now we can perform the accounting of those entries. We got already the general ledger. The two red arrows here means that we have performed the reconciliation with net income. I talked to you about that. Now what we are doing is categorizing this general ledger by category of P&L accounts. And we add the extended chart of accounts that I just talked to you about. So when we are here, we are able to go to the second step, which is data processing. So what do we do here? Two very important steps. Nicolas talked to you about the fact that when we have invoices, there are information on the invoices that we need in order to calculate the CO2 emissions. So we will get the nature of the purchase, the number of kilometers, the weight of the material, all information that we need when we want to calculate CO2 emissions. At the same time, we get generic data tables such as emission factors, for instance, but also external data from the suppliers of the companies that we are analyzing. This is important for perimeter called supply chain perimeter. Once we have all those information, we will put them in what we call activity data tables. So the activity data tables for the CO2 are the same categories as the ones that we have for the CO2 inventory, which are energy, travel, tangible assets, and so on. So for all those tables, we have very detailed information, starting with the financial accounts, but with supplementary information that we have added, as well as generic data. With all those information, we are able to go to the next step, which is the calculation of the emissions by category of information. And with all those information, we are able to integrate the data in the access model, perform the calculation, control the results, and perform the accounting entries that we need to perform. So on this last part, what we have activity data. We also have entries without impact. That's something that Nicolas talked to us about. We take them into our access model to make sure that at every time we are able to perform the reconciliation with the net income. And we also have those transactions that are not included in financial accounting, but are needed for calculating the emission of CO2. With all those information, we have this extra financial ledger, first by category of transactions, and then we sum it up, add up all ledgers, and we have a synthesis of the activity of the company in terms of emission of CO2. The last entry we will do is comparing the activity of the company in terms of CO2 emissions with the budget that was allocated for the same period. And this is the type of accounting that we have at the end. So the first two lines of accounting is the initial budget that was allocated to the company. So it's a type of grant and inventory on the asset part. And that was done at the very beginning of the year. Over the period, we have two types of accounting entries. On the one hand, we amortize the grant itself. So we have at the end of this amortization an income for the same amount as the budget that was allocated. And the second type of entry is the actual emissions from the activity of the company. And here we have 6,000 tons of CO2 equivalent that were emitted the same year. And we compare both. So at the end of the year, what we will do is compare the initial inventory that was allocated to the company to the debt that was actually appeared in the balance sheet of the company because of the emissions. And in that case, because the company emitted more than the budget that was allocated to it, we'll have a zero balance for the inventory CO2 equivalent, and we will have a remaining debt of 1,210 tons of CO2 equivalent. And now I will give the floor to Nicolas for the visualization of the results.
Okay, thank you very much. I'll take it back. Here's my screen again, if you can all see it. So now, what will the non-financial statements look like? What are the limits to be considered, and how do we contextualize the information? First, let's have a look at a non-financial income statement for climate change. What you see here is that the company had an income in CO2 equivalent of 4,790 tons, which corresponds to the grant, to the budget that it received. And through its operations and its supply chain and its products and services parameters, it consumed a budget of 6,000 tons of CO2 equivalents. Therefore, when we compute the difference between the two, it ends up with making a loss that is 1,210 tons of CO2 equivalent. The company consumed more CO2 equivalent than it had as a budget to start with. How does that translate into the balance sheet? We report that loss onto the balance sheet, and that loss becomes a debt which the company has because it used up more of its budget than it had at the beginning, and that debt is carried forward, meaning that if it wants to repay that debt, it has to repay it using the budget of the next year, and with the budget of the next year, it must repay the debt and continue its operations and the operations of its supply chain and the use of its products and its services. So here is what a climate change non-financial balance sheet would look like. Once you have done that, a certain number of items should be detailed in the appendix. First, the methodologies and the assumptions that we used to calculate the emissions should be specified so that you have access to the details of the calculations. And obviously, you need to analyze the results, and you have to do that in parallel with, you try to reconcile that non-financial statement with Scope 1, Scope 2, and Scope 3, which are well-known parameters when you carry out greenhouse gas emissions inventories and carbon inventories. And then you should also explain all the different elements that were not taken into account in the calculations and which should be considered as material, but you did not have the necessary data or the necessary amount of time to collect it. And all of that should be, of course, specified. Now, if we move on from a non-financial presentation to a presentation that uses other units, and since there seems to be a debate about translating it into monetary units, let's see what this translation would entail. So here we have an example. Remember, it's an example only. The value is to be determined if ever we take a value that's expressed in monetary units. But here, for this example, we have used 100 euros per ton of CO2 carbon equivalents, CO2 equivalent emissions. And so there, if we have 100 euros per ton, then we have a grant initially that's 479,000 euros. And the company uses CO2 equivalent more than it has as a budget at the beginning. It uses up 600,000 euros worth of CO2 equivalent. And therefore, it has a net CO2 equivalent income, which is a loss of 121,000 euros. Therefore, that translates into a debt of 121,000 euros. The question is, how is that then integrated with the existing financial framework? Is it really a debt? And how does it translate in terms of obligations to repay? Obviously here, there is a strong requirement that the law evolves so that it can be recognized. Now that we have looked at how we could present a non-financial statement of income using the example of climate change, a non-financial balance sheet, now that we have considered a translation into monetary units, it's time for more questions. And perhaps since we have just seen an example of how the model is applied to climate change, I'll start with a question for Hélène Le Thénault. Is what do you see as being the next challenges? And maybe is one issue how do we deal with a model that will have the ambition of motivating people to change things, but will be also presenting sort of bad news to start with? How do you combine the two?
I totally understand your question. Because within our company, when we said that maybe we could start with CO2, everybody viewed that as a limit or constraint on their business. So if it is presented as a constraint and not an opportunity for business, it's very difficult to give meaning for action and willingness to act. To be clearer about what I want to say is, depending on the business of the company and the sector of activities, my view is it's a lot more funny and easier when you understand how it relates to the DNA of the company. So for our business, a skincare company, based on dermatology, our DNA is to understand and take care of the living matter, the skin, the person, and the planet. Once we have said that, maybe we are able to take care of at the skin level right now, but not at the people level or the planet. So what we decided is, yes, we will put CO2 metrics, but we will also, and maybe first and foremost, put metrics about human capital, training of people, philanthropic activities related to human development, because the main focus of the company was to foster human development and protect life. And the same for ecological matters. We could have launched a very serious CO2 action plan, but we started by an action to preserve sea life and protecting seaweeds in Mediterranean Sea, because it's a carbon sink, but also that's the place where fish can raise their little fishes. So that sounds silly, but what I'm trying to say is to give more power to figures and more willingness to act. It needs to relate to action plans that are the most fitted to the DNA of the company. I don't know if I answered your question, Nicolas.
No, it's very interesting. You say you've got to give people a feeling that they can act.
Yeah, and that it is the same strategic goal than the one they already had. It's not something more. It's not something on the side. It's not a constraint. That's what they were doing, but much better.
Okay. Thank you very much. Delphine, if you can step in, are there questions from the audience?
Yes, there are. There was an earlier question on the part on the science-based targets about wouldn't it be interesting to already target the 2000s? So I don't know if it was 2030 or 35 figures that was meant, so as to make the do not more meaningful in terms of long-term target achievement. I understand the psychological effect of the step-by-step, but I fear that it's not helping us increasing the pace. This is a discussion we've had.
Yes, that's what I was going to say as well. We had very heated debates about that question, and we are sort of torn between the idea that yes, we need to present a strong imperative and a strong objective to be met straight away, but also the fact that if the objective seems sort of impossible to reach, people would just lie down and say, well, too bad. So the point of our accounting model is that it drives and it challenges people to transform their organization. And if we make the objective sort of seemingly unreachable to start with, managers will not follow. But we have debated that issue.
Yes, and maybe there'll be more discussion when the experiments are presented. There is also a question from Maud about how many years would you advise to build for historical comparison, and then is the extra financial ledger built during monthly closing process of the current year?
Okay, Emmanuelle, would you like to contribute to that answer? There's one answer I can start with, and then Emmanuelle, if you'd like to contribute afterwards, is to start with, the method is likely to evolve as scientific knowledge evolves. So a historical outlook will have, can exist and can be produced, but you'll have to bear in mind that there might not be consistency in the methodology from one year to the next as you try to improve measurement. So that's a difficult question. Should we change the methodology so that we improve how the company knows where it stands? Or should we not change it too much, that we have a historical outlook that is consistent? The debate is open, but I would be in favor of improving the knowledge as our knowledge, the model as our knowledge improves. Emmanuelle, if you'd like to add something.
Yes, maybe to the second question, our objective is really to build the extra financial ledger at the same time as the financial ledger. So this is like a objective that we have. We know it's going to be difficult, but this is why, as Delphine explained this morning during the first session, we are working with partners, IT partners, and hope that we will be able to facilitate the production of this extra financial ledger. So this is really one of the objectives, is to have extra financial result at the same time as financial result and the same frequency. Thank you.
I think maybe if I can add, the model builds on two principles we have. One is to build on science and to be very close to what science is telling us about sustainability, and to be very pragmatic about how we can follow up with actions and how managers can then build on what we've done and the results that we have connected to be able to bring some relatively useful information. This is why we also wanted to have potentially a monthly basis and follow up accounting as much as we could. We have more questions here, Nicolas, from Roger Barrett. Do you or could you have a capital maintenance account associated with each form of capital? This would allow the articulation between the capital stock and flow. The result would reveal a simple way whether the planetary and social boundaries are being exceeded for each time period and at different points of time as a variance from budgets.
What I can say at this stage is we consider that the capital is maintained as long as the budget is respected. And this is how we decided to integrate the idea that capital is maintained. Based on science, what is the global budget not to be exceeded? How do we translate that global budget into a budget at the level of an organization? The capital is maintained if the budget is respected, or if the obligation is met, if we talk about social foundations. That's how I can answer this question at this stage.
Yes, thank you. I think we've gone through the question. Nicolas, do we have a...
We have a few more minutes for the next steps.
Yes.
Perhaps one more question. Okay. I'll share my screen again. So very quickly, what are the next steps, the development of the method? We have a number of challenges ahead of us, a lot of work. One of them you have understood is that we have the ambition to capture the physical data at the level of granularity of accounting entries. In reality, we will be confronted to what type of data exists in corporations, and we will have to adapt our model to existing data granulometry if we are to apply it. Then we still need to work on measuring economic performance. How does this model imply economic performance? How do we measure it? And we need to think about that. We also need to better think about the methods that take into account the business model and the society parameters. Exactly at the moment, we analyze the business model, we identify a number of red flags, and then we capture physical data at the level of operations, supply chain, and product and services which make up the business model. But we need to consider society. We also need to embed in the model a consideration for the quality of the data that we use. Do we use primary data, secondary data, data from databases, specific data that is captured by the company? And also, another thing that we need to consider is the questions of goodwill, inventory, and debt. If you consume more CO2 equivalent emissions than your budget, what happens to the debt? How long can you have a debt? When your total debt exceeds your budget for 1 year, are you, from a carbon point of view, bankrupt? What are the legal consequences? If, on the contrary, you are a very good company, you respect your budget and you use less CO2 equivalent than your budget, what do you do with the surplus? Can you keep it? How long? Our objective is that you probably can't keep the budget. But how do you translate that into some sort of goodwill? We still need to think about these questions as we try to apply the model. So a lot of work ahead of us for the development of version 2 of the model. And perhaps we can take one more question from the public, and perhaps another contribution from Hélène Le Ténon. Is what I would like to know from the point of view of the foundation and the company, Hélène, is what projects do you have in mind that you haven't shared with us yet, where this accounting model might play an interesting role?
Well, in the mid and long term, my concern is how a company can really create value for the society. That's to say, for global health, for instance, or social justice. Each of the two are closely related to environmental issues as well. Everything is intricated. So when you were talking about goodwill, about other evaluation of the company, and not only in a budget view, and not only in a short-term or short-mid-term view, I would say that this is really my concern, is what brings people together and how can we define that the company is creating value for the long term for itself and also for the society. So in this type of new accounting frameworks, I'm very much interested into the budget aspects, but also in the balance sheet global view. So budgeting is really much needed for the teams to make progress and to track their progress. But the balance sheet view is the view of the owners of the company and of the board, and they also need a new common language at this point. And that's what I see as an exploration for the years to come, a promising one. And if figures can help us to think and adjust and make new design of businesses for the future, then it would be a very good news.
Okay, thank you very much. Delphine, perhaps one last question for the audience, if there is one.
Yes, one last, because it's already time, but there is a question by Patrice on the allocation of CO2, and there's lots of questions on this budgets, and I've referred people to not the next, but the conference. Sorry, I should have put myself on from the presentation of Richard, who will be taking the floor with Geoff Kendall and Bilbao from our 3.0 and discussing this particular topic. But Patrice is asking whether to understand where the CO2 revenues comes from the consumer, or who pays for the bill. So maybe we can just clarify this.
We consider here that from an investing point of view, if we have a non-financial statement for carbon, nature is in the investor. It puts into a company an allowance to use carbon, and that allowance has to be respected so that the natural capital is maintained. This is how I would answer the question.
Great, thank you. And we have a question from Martin, but I'll just say that we are working on it about how to bring that to a multinational with subsidiaries. So Martin, this is exactly what we're going to do with Danone and L'Oréal. This is actually a question that we have been discussing in our last meeting with them. The next step, and one of the many challenges, will be to do this with inter-subsidiary transactions. So stay tuned for the next annual conference. We might have a beginning of an answer next year. And Nicolas, I'll leave you to close the session.
Yeah. So coming up after the break, the presentation of the case studies with the 3 SMEs. And then for all those of you who had questions about budgets, the presentation by Richard Jabot of the report we did on planetary boundaries and social foundations. And of course, you can stay tuned with us and look for more information on the web pages of the Research Center. Well, thank you very much to Hélène Le Ténor for being a panelist and contributing to the discussion, and to Emmanuelle Cordano for sharing the presentation with me. It was a pleasure, and I hope you have a great conference and you will enjoy the sessions to come. Thank you very much.